So what is marginal tax relief? So marginal tax relief applies if your company makes a profit between 50,000 to 250,000. So as you know, from April 2023, if your profits are above 50,000, you will fall into the higher corporation tax category. If your profits are less than 50,000, 19%, no issues. But if your profits are above 50,000 and within 250,000, we will have to do something called a marginal tax relief. So how that is calculated, I'll explain it in the next slide. Basically, what happens is on the first 50,000, you pay 19% tax, and then balance up to 250,000, you pay 26.5% tax, and combining that will be a total corporation tax. Obviously, this will help some of the companies to reduce their tax bill if they're making a profit less than 250,000. But if they're making a profit above 50,000. Who cannot claim marginal tax relief? Not everyone can claim marginal tax relief. If you are a non-UK resident company, what I mean here is anyone in UK, anyone in the world can have a UK company. They can own the company. They can carry out a UK company. But if that company is not a UK tax resident, meaning that the central control management of that UK company is done outside of UK, they're a non-resident company, which means they don't get that relief. So, they pay 25% straight away. Or you're a closed investment holding company. When I say closed investment holding company, what I mean is companies which own shares in other companies. So, there's a lot of the holding companies, so like a parent companies, they don't do any other trading activities except their main trade is, holding the shares of the company and getting dividend income. And the last point is your profits, including, associate companies, go over 250,000. If your profits are about 250,000, you can't say, okay, first 50,000, pay 19%, 50,000 to 250,000, pay, marginal tax relief, and about 250,000, 25%. That doesn't work like that. Even if you go above by, 1,000 pounds, about 250,000, unfortunately, you will become 25% taxpayer, 25% corporation taxpayer. So that's something to keep an eye on. Key points, accounting period adjustment. So limits are proportionally reduced for the accounting period shorter than 12 months. So what you can't do is, okay, this change in April, so you can't shorten the year or, extend the year end to get the reliefs. You can't do that. Those are proportionate based on the time frame. So even if you did trade sales up to March 23 and your company year end is August, you can't say, I want to pay 19% onto March trades and I want to pay zero tax on, from April to August. You can't do that because it's proportionate. Associate companies. So obviously, this is going to be a bigger topic. So we'll come to this topic, this subject in few slides down the line. The same thing I told you earlier, just a worked example here. If assuming there's no associate companies and no dividend distribution, if your company's taxable profit is 80,000, the corporation tax will be calculated as follows. So first 50,000, you pay 19% corporation tax. Rest of the 30,000, you calculate 26.5. So combined is 17,450. Effectively the marginal tax relief on that is 2,550. So how that is shown is if basically you calculate 25% on 80,000, 20,000 minus 17,450 is 2,450. So that's just the relief, but the tax will be 17,450. Identifying and managing associate companies for tax efficiencies, right? So this is going to be the key area for a lot of our clients, especially the clients who have the limited companies owning properties. So they'll become the associate companies. So associate companies are basically they have to meet certain conditions. So one is majority share capital. So if you have two companies, if you are the shareholder on both companies, and if you're the majority shareholder, obviously those two companies are associate. You might not have the share capital, but you might have the voting power. So some companies set up in different classes of shares where they have less shareholding, but they have high voting power. So effectively those two companies will become associate company. Right to distributable incomes. When I say distribution income, I meant dividends. So if you have, less voting rights, but high dividends, sometimes A and B class shareholders, some people have less voting rights, but high distributable dividends. So, in that case also, they'll become associate companies. And lastly, rights to asset on winding up. So if your company is closing down or going to MBL or liquidation, what is the gain, who's getting the gain, and you can based on that also. Types of control, the same thing I told you earlier, just further elaborating that. So actual control is exercise, entitled to exercise over the company's affairs. So I can have a minimum shareholding, but I can, if I control another company, effectively that company is a associated company. And if I participate in general level meetings, but not on administrative board level meetings, but still a controlling person. Attributable control, where this is basically based on the voting power, share capital. So primarily based on shareholding. So minimum controlling combination. So sometimes when you have different combinations of classes of shares and voting rights, it becomes very complicated. So you'll have to get all the combinations and make a call whether you have a controlling controlling this thing on the second company, and we'll have to make a call with that particular company's associated company and not. So we'll go through some of the examples here. So minimum controlling combination. So this is purely by the shareholding. So we've not considered any other things that I mentioned earlier. So company A is owned by Mr. A, so 100% owned by Mr. A, and company B is owned by Mr. B, 100%. So they're not associated. Two different companies, not association. Say company A is owned by 50% by Mr. A and 50% by Mr. B, and company B is also owned the same way. Then they're associated because there are two different companies, but they're the same similar shareholder combinations. They are associated. And the last combination is company A is owned by 50% by Mr. A and B. Company B is owned by 1/3 by A and B and Mr. C. Because A and B are 2/3, they have the majority control over company B, so they'll become associated companies. Okay. Now people might say, okay, because I don't want to pay extra tax, I don't want to be non-associated, so I'm going to get my wife to open a different company, or my brother to open a different company, etc. Right? And there's a rule on that also. So what HMRC says is, if you're not connected by shareholding, Mr. A and Mr. B, say two brothers, but if they're family, the siblings or real partners, effectively HMRC might consider them as associates too. Same with business partners. If you have two different business partners, but you both set up two different companies to mitigate this, if there's the same business interest, HMRC might consider it as associate company. And trustees. So sometimes when you look at companies, you only see the front of it, but there might be trustees on settlement where they have interest. So if somebody has passed away and there are two different companies, but if the trustee gets those two companies, effectively those are associate companies. So on going back to this example, so say you and your brother set up two different companies. Effectively, you do not become associated automatically. So HMRC has to go through a check. We had to go through a check, checking whether those are associated companies or not, based on three different things. One is the financial independence. Second is the economic independence. Third is organizational independence. So if you are independent from each other, then obviously you can treat as non-associated companies. But if they are not independent, it has to be treated as associated companies. For example, say you and your brother have both are interested in creating the IT, right? One brother has a separate company who does web designs and SEOs and stuff, and they work in the same premises. And another brother has a graphic designs, and they pass on ideas, but they run as two different independent companies. In HMRC's view, those are two independent companies. But if those two brothers have similar clients coming to one company and they keep passing work at each other, then it'll become an associated company because there is some kind of financial independence. So the first check is the financial independence checks. So we have to check whether the company A provides intercompany loan or any support, any guarantee, etc. So there is a dependency. The short-term loans, personal loans, directors give, it might not be considered as a financial independence because that doesn't have a significant operation. But if HMRC considers such loans and such personal guarantees do have a significant impact on the operations. For example, the brother A might give a loan to brother B saying, I can give this loan on my personal capacity, but I want you to do these contracts on behalf of me. So then, you're creating a dependency. So, it has to be kind of quite minimal operations to have independent in between both companies. Commercial independence, when companies share same economic goals. For example, if father and son say run a building company, and one of them supply building materials, other one is in the building trade, there is a kind of a link between them, because one person might say can give you discount, another person might buying from the father because they get discount. So there is economic independence between both parties. So then it becomes associated companies. And organizational independence. So sometimes, early example I told you, two brothers, even though they have two different companies, but if they share the employees, the premises, the equipment, all that, effectively that might become a associated company too. And also having common management, shared employees, have same facilities, etc. So what's now the other thing is, why a social company is different is why this social company is very important is, for example, we spoke about 50,000 limit earlier, right? I'll go back to this slide, especially on this scenario. So you have, say, company A makes a profit of, say, 45,000. Say company B makes a profit of 5,000. You might think, in jointly they have made a profit of 50,000, so they should pay corporation tax of 19%. But that doesn't work that way, because there are two companies owned by same parties. The 50,000 get divided by two companies. So this company's limit will become 25,000. So up to 25,000, they pay 19% tax, and balance 19,000, which is up to 40. Balance 20,000, because I said 45,000. Balance 20,000, they'll have to pay 26.5% tax. Whereas this company will only pay 19% tax, but they've not utilized the maximum of 25,000. So it's very important to do a bit of tax planning when it comes to if you have intercompanies, right? Some of the key things you probably have to consider after this rule change is closing down inactive businesses. So if you're trying to help your brother or spouse or somebody else or friends, and if you're part of those companies, it might be better off you coming out of those companies and then exiting those positions. Or if you have set up a company to do something some time ago, but it's not working well, etc., you better off just closing those companies. Dormant companies will not be considered as a associated company. So if you have two companies that are companies completely dormant, then we don't have to divide that 50,000 by 2. We can just leave it as is because that company is dormant. But if you have a inactive business but not in dormant status, it might be better off just coming out of that position or closing that position down. And the second point is combining activities. Rather than having multiple companies to do similar sort of work, it might be better off just combining both and carrying out within the same company. Because you obviously limit will become 50,000 that way. So if you have similar sort of work that you're doing within two different companies, it might be better off just combining both. Group structure holding company might be better off thinking this portion if you have multiple companies, because you can pass the profits back to the holding company, and holding company will and take the tax the dividends from the holding company. It's a bigger topic, but if you're interested, we can talk you through this one. And financial year planning. So you have to make sure you allocate the profits, and the taxes, the taxable profit is maximized. For example, pensions and things like that. Just for example, if you make a 60,000 profit, then it will be much better off paying a 10,000 dividend to bring it down to 50,000. So, we do provide a lot of this help when it comes to tax planning, especially inviting you to join the pre-year tax call with us. Also, we send a lot of emails before the year end saying that, your year end is in a couple of months. Do you want to do this, etc. Right? So, and also if you use our online portal, you can see all those, the potential tax number on that one. So you might have to do some tax planning around it before the year end. And people who do tax planning before the year end always tend to save tax than people who have a very reactive approach of looking at the tax number after the year end. So, you have to keep a very close eye on the tax number before the year end rather than waiting for the year end to happen. So a lot of our clients, this will impact people who have a contracting company or a main company and a property company. So make sure that you do some tax planning when it comes to your end before staying with massive tax bill. That's it from me. I know I rushed it through. It's quite technical, so I kind of try to avoid a lot of the technical part. But the key point is, making sure you understand this combination, and also, the corporation tax going to work, and this big tax number after 50,000, right? So you have to make sure that you do some tax planning pre-year end to reduce that tax number. Cool. That's it from me. I'll stop sharing the screen and we